everyone, my name is John Gavin. I'm with Family First Life North. Sean, thank you so much for having me on today's advanced market sales training. What I'm going to go over is how to utilize today's market conditions to increase your annuity sales. A little bit of background on myself is I wrote my first annuity 4 years ago. It was on a door knock, so make sure you knock on doors. You just don't know what they're going to turn into. It was $327,000. I finished with about $400,000 total volume that year. Followed up next year with about $500,000 in issued business. I lost a lot more than I issued that year. And then last year finished with about 1.6 million in closed business. And this year I'm at 1.2 million with a goal of 5 million for the year. And how I think my production increased over the last year and a half is I really simplified things. I think I was complicating things a little earlier on, and I wasn't asking the right questions. I would look at someone's situation and how I wanted to fix it and show them something that could fix their current situation without asking the right questions. And I think it's vital to annuity sales to find out how exactly they want to access that money, if at all. And you ask the right questions and you find the right solution to whatever their concerns are. And you shouldn't have any problems writing annuities, especially in today's market, because there has never been a better market for the products that we have than there are today. And I'm going to show you a few things that I use that it's really simple stuff. It's something that if you've never written an annuity before and you're just learning what they are, this is stuff that you'll be able to take out on day one and show your clients and talk about it with conviction too. Because I think that's the most important part of our annuity sales is the conviction part of it. We do a great job of having conviction when we're talking about life insurance, mortgage protection, final expense, and it's because we know that everyone's going to die at some point. Well, what if you were able to take that same conviction and translate that into your annuity sales? And how much more production would you have there? How many more retirement plans would you be able to protect? And how much income would you be able to earn for yourselves? Now, I've got a lot of conviction when it comes to my annuity sales. And the reason why, first of all, what is conviction? It's an unwavering belief or opinion in something. And I have an unwavering belief that the markets are going to see a major downturn in the near future. Now, I don't know if it's going to be a month from now. I don't know if it's going to be a year from now or 18 months. But history says we're due for a correction, a bear market, a recession, something big. We just don't know what it's going to be. Since 1929, it's been every 8.9 years that we've seen some sort of bear market. And that's when the markets decline and go down. And we're at 10 years now. So we've been at quite a run. The markets are at an all-time high right now. And they didn't just reach an all-time high, last week or a month ago with a chance of pushing higher. The official all-time high is about 9 months ago. But realistically, they've been bouncing around there for about 2 years. And so the economy was doing great, and all these economic factors pushed the stock markets up. And for the last 2 years, been kind of bouncing around the top there. And the last two times that happened, it did it for a little bit, then we saw some significant losses. And so one of the things that I use is I use history. I'm not a Series 6, not a Series 7. I don't have any other license other than an insurance license. I don't have a finance degree in anything whatsoever. So I use history, and I use things from Market Watch, and I use Google, because Google is really simple, and I can Google things and find things and show my clients things that they may not be aware of. And so if you look back at the last 20 years, and I'll just take the S&P 500, because that's the top 500 stocks in the country. And you look at the 20-year history there, and here's my little simple chart here, and I usually print something like this up and bring it to my clients and show them. And you can find this, like I said, off Market Watch or Google, the S&P 500. And so you can see here that after the 90s, we saw a pretty good run, and it was the tech stocks that were really taking off. And then in 2000, we hit a peak with the S&P 500 of 1,500 points. But then they realized that tech stocks weren't actually worth any money. The companies weren't generating any income. And then we saw the crash there, where it actually lost 45%, okay, in a very short period of time. So stock market crashes, loses 45%. Took a little while to start turning back around, and the turnarounds are a little bit quicker than the gains are. But if you're retired and you're utilizing that money, once that market goes down and you're taking some withdrawals, you never gain that portion back. And so then we saw a little bit of run with the housing market. The housing market took off, and right around 2007, we saw the S&P hit 1,500 points again. So that was 7 years from 2007, from the time that it hit a peak of 1,500 originally, dropped down until it got back to the original amount of 1,500. Now what that means is that if someone was retired, and just for round figures, say they had $100,000 and they had it in the market and they lost 45% of it, it took 7 years for them to gain back to their original $100,000. Okay? So then we saw the housing market, mortgage market, whatever caused the last recession, and it crashed down and it lost 49%. Okay? So again, you had $100,000 in the S&P 500, which actually outperforms most mutual funds. Now you've got 51,000. Okay, and so, and again, if you're taking withdrawals off of those, you're not going to gain that money back, even the market does go up. So then the market bounced back, which it typically does, and it took 6 years for it to get back to 1,500. Okay. So, and again, any withdrawals taken in there, you're not going to gain those funds back because you're taking money out of there. So we've seen twice in the last 20 years where the markets hit an all-time high and it took a dive of 49 and 45%. And it took 7 years just to get back to zero. And so here we are today, and the market, the S&P is actually at 2,900 points or just above. We hit an all-time high, like I said, last September. But it's been doing it for bouncing around for like about 2 years, just like it did here and just like it did here. And so all the indicators are showing that we're going to see some sort of major loss coming. Like I said, we don't know if it's going to happen next month or next year. But there's 19 indicators that show a bear market is on its way very soon, and we've triggered 14 of them. And so when we're sitting with clients, it's like, okay, you've been on this 10-year stretch. It's a bull market that we've never seen before. It's officially the longest bull market that we've ever had. What do you want out of your retirement now? You've got it exposed to the market. You've got it at risk. What do you want to gain? Because if you've got $200,000 in an IRA and it's at risk there, you're basically, if you want to go by the last two losses, you're putting $90,000 of your retirement at risk. And if you want to put that into years, if you've worked 40 years to get that, you're putting about 19 years worth of contributions at risk. For what? What are you trying to gain out of it? Are you hoping that this is somehow going to recover and push a little bit higher? Because if you are, you've got $90,000 or 45% of your retirement at risk, hoping something happens that has never happened before. The markets are at an all-time high right now, and you're expecting them to push a little bit higher. Okay, so that's crazy for people to leave their money in the market. Now, for those people that we meet with and they say, oh, we love our advisor, he's done a great job for us. He has, because his job's been really easy. There's a lot of advisors we come across that haven't been in the business for 10 years. All they know is they got hired there, and here we are today. And so all they've seen is an increase. They don't know what it's like to have clients call them because they just lost 45% of their total portfolio. So our clients are lucky because we have products that can solve these problems. Okay, so instead of having $90,000 at risk in hopes of gaining who knows what, we can secure all this and give them 5%. We've got a bonus, like that last little bark they're trying to squeeze out of it. I tell them, okay, what would 5% feel like? If you're trying to squeeze 5% more out of the stock market, I'll tell you what, I'll give it to you, okay? Because Athene has a great product in my state, has a 5% rollover bonus with no fees. And so you can take the risk off of this. We'll add 5% in your account. And then when the market does dive, because I wholeheartedly believe that it's going to, you don't lose anything. And on the upswing, rather than trying to gain your money back, you're gaining, okay? Because the whole amount's going to be secure, and the markets bounce back. Instead of getting back to zero, we participate in those gains, but none of the losses. And even at an 80% participation rate, rather than having $100,000 or $200,000 after 7 years, you're going to have $365,000. because you secured the entire amount and you just gained a portion of the gains after that. Now, doesn't that make sense? Okay, so we have clients that still, they don't want to face the fact that their money's at risk. One of the things that I do is I will take their statements and I'll look at where a majority of their money is. I look at the biggest fund that they have there. Most of them have mutual funds. And I'll Google the ticker symbol. And you Google the ticker symbol and you look at the history of that. And most mutual funds, and I just grabbed one out of the thin air. I looked at one of the top 10 mutual funds that advisors are saying this is a must-have for 2019 because it's gained so much in 2018. This must-have for 2019 lost 55% in 2000 and 58% in 2007. So advisors have their clients' money at risk because they're following trends and whatever their brokerage firm tells them to put the clients into based off of risk factors, but they're not looking at the chances of losses. Now, if you look at the markets where they are today and the trends that are going, even if you look up some of the big brokerage firms, Merrill Lynch and Bank of America and some of those other companies, they're telling their clients to move to something safer. What I tell people, that I ask them, has your advisor contacted you to talk to you about moving your funds to a safer fund? And they say, no, they haven't. If they say that, I said, I'm sorry, but you don't have an advisor. Because most are, the big dollar accounts, they're actually preparing them for those losses that are coming. And if you haven't gotten that call yet, because we serve the middle America, $100,000, $200,000, $300,000 accounts, those aren't actually being managed. If they call up, they can get an answer or two about their account, but they don't have somebody overseeing it that's going to help them out. And that's where we come in, okay? We serve middle America. We find them through lead sources. We find them through referrals, wherever it may be, and we sit down and we show them how to protect their assets because somebody who's got $5 million in an account, if they lose $1 million or $2 million, they can still survive. Somebody who's got $200,000 or $150,000 and they lose half of that, their quality of life changes. So our products are so valuable for the people that we serve, the middle America people, because we're preserving retirement plans. And so just by asking a few questions and utilizing the market like this and a simple graph like this can help somebody out. And by keeping it simple and showing the products, like the Performance Elite 10 is what I mostly show people, you show them how much sense is it to leave your money here, try to squeeze out a couple dimes, when I'm going to give you 5%, I'm going to protect the whole amount, and we have no fees whatsoever. So I get a little worked up when I talk about annuities because I believe in them wholeheartedly. And I think that if we can understand the strength of the products that we have, the risk that's involved with some of the clients that we're meeting with, we can actually help our clients protect their retirements, and we can make quite a good living for ourselves too. So that's what I've got for you guys. Hopefully that helps. Any questions, please feel free to reach out to me anytime. Thanks.